Hello, Ms. Klein. Our financial investing group hopes that your cruise is sailing smoothly. Since we want you to enjoy your oceanic vacation, we'll just dive right in. You expressed an interest in the retail industry. Well, Walmart and Target are the two top companies to invest in. But why? Well, they're some of the most recognizable big box stores in the country. The first Walmart opened in 1962 and has been in operation for 56 years. Since its inception, it has become a multinational corporation and currently employs over 2.2 million employees worldwide. Target has had similar success, also first opening in 1962. It has over 1,800 stores in the U.S. and over 300,000 employees. Both Walmart and Target have been successful in becoming dependable sellers for consumers, providing convenience and affordability. So, to best advise you as to which company you should invest in, we analyzed each company's income statement, balance sheet, investing and financing activities, and their charitable contributions as well as environmental sustainability practices. So, here are our results. So let's start with the income statement. Walmart's net income performance appears to be deteriorating. This is alarming, since net income is one of the most important measures of a business's profitability. Their net profit decreased by 7.15% from 2016 to 2017, which is a substantial drop. But Walmart's performance for gross profit appears to be improving, increasing by 2.07%. Their performance for interest expense also appears to be improving, seeing an 8% drop. A decrease is good in this case, Ms. Klein, since we're dealing with an expense. However, Walmart's drop in net income overshadows these improvements on their income statement. Moving on, Target's net income performance is greatly improving, seeing a 7.2 increase from 2016 to 2017. This is a good indicator that Target is a profitable business to invest in. They also saw a 1.99% increase in gross profit, which is also a good sign. Additionally, Target saw a dramatic drop in their interest expense, decreasing by 33.67%. This is a significant improvement. Overall, Target's income statement indicates that it's a profitable company since it experienced an improvement in every single item we analyzed on their income statement. We can use the profit margin ratio to evaluate a company's profitability. It tells us the percentage of profit that the business made on every dollar. As you can see, Walmart's profit margin decreased by 0.22% from 2016 to 2017, which is not desirable. But Target's profit margin increased by 0.14%. Not only that, but Target made 1.25% more profit on every dollar than Walmart did in 2017. So in this specific aspect, Target outperformed Walmart. But Walmart's gross profit percentage increased from 24.58% in 2016 to 24.94% in 2017. So it's fair to say it's remained stable. But Target saw a 0.41% decrease. Now let's talk about the times interest earned ratio. It evaluates the ability of a business to pay interest expense. Walmart saw an increase of 0.14% from 2016 to 2017, while Target saw a 1.46% increase. Once again, Target far outperforms Walmart. Now, let's talk about Walmart's balance sheet. First, we analyzed cash and cash equivalents, the company's most liquid assets. It's how much cash, including items similar to cash, the company has on hand. Walmart's cash and cash equivalents are deteriorating, dropping by a whopping 21.11% from 2016 to 2017. This might have something to do with Walmart's 7.15% decrease in net income, which we mentioned earlier. Walmart's sale of common stock is also deteriorating. They sold 3.79 less common stock from the year 2016 to 2017. The amount of their accounts payable increased by 7.65%, which is a current liability. However, this is not an issue in Walmart's case. It could mean that they are expanding their operations faster. And, according to their working capital, they're in good short-term financial health. But we'll talk more about that later. Now let's take a look at Target's balance sheet. Target's cash and cash equivalents are improving, increasing by 5.21% from 2016 to 2017. However, sales of common stock saw a decrease of 2.17%, so it is deteriorating. As for the accounts payable, there was an increase of 19.65%, though this could mean that Target is trying to increase its growth. However, this might not be ideal since they experienced a substantial decrease in working capital. So, it might have difficulty paying its current liabilities with its current assets. We will talk about more of this in a moment. Now, let's compare and contrast some of Target and Walmart's financials. We used information from the balance sheet to make these calculations. So working capital is the difference between a company's current assets and current liabilities. It can help us measure a company's short-term financial health. Walmart saw a 4,859 million increase in its working capital, while Target actually saw a decrease of $80 million. This means that Walmart is better able to pay its short-term obligations with its current assets. So now, let's take a look at the cash ratio. It calculates a company's ability to repay short-term debts and liquidated funds. Walmart saw a decrease of 0.03 in their cash ratio from 2016 to 2017, which is not a lot. So it's fair to say that it's remained stable. And the same goes for Target, with its cash ratio remaining constant for the last 2 years. So in this regard, both companies are rather equal.
We also analyzed both companies' largest investing and financing activities for the most recent year as identified in the statement of cash flow. Let's start with Walmart. Their largest investment was in payments for property and equipment. We agree with this investment since the payments are going to pay for assets such as buildings, land, fixtures, equipment, and so forth, which are used in the operation of business to produce capital. The second largest investment activity was investments and business acquisitions, net cash acquired. Again, we are in agreement. This allows the company to expand their investment portfolio. Net cash also represents the flow of cash acquired for the company over a given period. Now, let's move on to Walmart's financing activities. The largest financing activity was purchase of company stock, which we are in agreement of. This allows the company to repurchase some of the stocks they have already sold, which is important when considering current cash needed, market price of common stock, and so forth. This may have been done to reduce the number of shares in the market and increase their price. The second largest financing activity was dividends paid. Again, we agree. The payments go to the stockholders who have invested in the company. The company is liable for these payments. Moving on to Target's largest investing activities. The largest investment was payments for property and equipment. We agree with this. Again, this goes towards assets used in everyday business and production. The second largest investing activity was investments and business acquisitions, net cash assumed. Again, we are in agreement. This allows the company to diversify their investment portfolio. Net cash also represents the flow of cash assumed for the company. Now let's move on to Target's largest financing activities. Their largest financing activity was reduction of long-term debt. We agree with their decision. This allows the company to avoid taking on too much long-term debt in order to reduce the risk and costs closely associated with unstable forms of income. The second largest financing activity was dividends paid. We agree with this, as Target is obligated to pay stockholders their share of company profits. Let's look at a comparison of the amount of money used for each payment. It's important to note that one of Target's highest financing activities was the reduction of long-term debt. This shows that Target is making the reduction of their debt a priority, which indicates that the risk and costs associated with an economically unstable company are being minimized. Walmart pays a higher amount of money overall since they are a larger company than Target. However, this does not necessarily mean Walmart is more profitable. Referring back to the profit margin from earlier, Target made 1.25% more than Walmart on every dollar in 2017, even though Target is a smaller company. We also analyzed two items that aren't included in the financial statements: whether the company donates to charitable causes and practices environmental sustainability. Let's start with Walmart's environmental contributions. In 2017, Walmart launched Project Gigaton, asking suppliers to help reduce greenhouse gas emissions from its supply chain by 1 gigaton. The company also sets a new goal to reduce its chemical footprint by 10% by 2022. These are just two examples that show that Walmart is trying to conduct business without producing negative externalities for society. This can encourage consumers to shop at their stores and increase their sales revenue, which would be good for you as an investor, Mrs. Klein. As for their charitable contributions, Walmart donates more than 600 million pounds of food and $50 million to fight world hunger. Not only is that great publicity for the company, but also a tremendous benefit to our society. Now, let's take a look at Target's environmentally friendly practices. In 2017, Target launched a new chemical policy to make the chemicals used in their factories and packaging plants public. They also worked closely with owners and operators to develop a new, safer chemical protective plan and develop safer practices for chemicals used throughout the factories. They expect to invest $5 million in green chemistry by 2022. This is great news for investors. Once again, consumers are more likely to shop at retailers who try to minimize the negative externalities that can result in the production process. Let's move on to their charitable contributions. In 2017, Target made a $14 million commitment to the local youth soccer programs through 2 new national incentives: the Target Soccer Grant Program and a partnership with the U.S. Soccer Foundation. They hope to build 100 new soccer fields by 2020. Once again, this is good publicity for the company, but they also better our society. Both Walmart and Target engage in charitable activities and practice environmental sustainability, which is a huge positive. However, Walmart does surpass Target in this regard. But this is only because Walmart is a larger scale operation and have more funds to do good. Regardless, both companies are attempting to better society, which is a commendable effort. Well, Mrs. Klein, we've reached the end of our report.
And after our extensive research, we've determined that you should invest in Target. Even though Walmart is a bigger business, Target has a better profit margin ratio. And Walmart's net income is deteriorating, which indicates that Walmart might not be so profitable to invest in, at least for now. While Walmart may have surpassed Target in some aspects, Target is improving in key areas, as we've reviewed throughout this video. If you have any questions, please don't hesitate to contact our investing group.
We hope you have fun on your vacation, Mrs. Klein.